Hello and welcome. Before we start, please make sure to subscribe to our YouTube channel for news and updates. As with many things in life, knowing what we're supposed to do and actually doing it are two separate things. When it comes to investing, it's well known that properly diversifying and staying invested are the best ways to achieve long-term financial goals. However, this is often easier said than done, especially when market and economic outlooks are uncertain, as they have been for many years. Fortunately, there are investment methods for managing the emotions that come from market volatility. What should investors know about how they can stick to an investment plan through years and decades? Dollar cost averaging and lump sum investing. Knowing when and how to invest in the stock market can be challenging. This is where dollar cost averaging can help. With dollar cost averaging, investors regularly invest a set amount on a pre-planned schedule. This reduces the temptation to follow and react to every market move or to try to time the market. If you already make regular automatic contributions to your portfolio with each paycheck, such as through a 401k plan at work, you are technically already using dollar cost averaging. Whether these investments occur monthly, quarterly, or annually, turns out to matter much less than simply sticking to a plan. This chart also shows the hypothetical returns of a dollar cost averaging approach, in which the investor splits up the $100,000 into monthly investments over this full period. This is a rather extreme example given the length of the time period, but it serves to highlight some key facts. Dollar cost averaging can make it psychologically easier to invest. The takeaway here is less about how to maximize returns than how to stay invested through years and decades. Dollar cost averaging can help reduce risk in situations where markets fall sharply, especially early on. The 100% stock portfolio might outperform over long periods, especially during strong bull markets like today's, but it will also experience sharper pullbacks. The diversified portfolio, on the other hand, will experience steadier growth and more muted declines, making it easier for investors to stay level-headed. It's important to keep in mind that just because the market is near a current peak doesn't necessarily mean it's due for a pullback. By definition, markets achieve many new all-time highs as they rise during bull markets. While there has been significant uncertainty this year due to interest rates, inflation, and the Fed, the S&P 500 has already experienced 24 new all-time highs. This includes a sharp rally in May after a slump in April. Getting invested sooner is better than waiting for the right timing. As the accompanying chart shows, waiting for a better time to buy or trying to buy the dip has tended to backfire. Since the market tends to rise over time and can rebound unexpectedly, even the worst timing is often better than being out of the market. Just as a diversified portfolio can help reduce overall risk and volatility, so can dollar cost averaging when it comes to investing over time. Dollar cost averaging may not be the mathematically optimal way to invest, since lump sum investing has tended to outperform over history. However, it can help investors to stay focused on the long run, without worrying about every market event or trying to time the market perfectly. As is always the case, seeking the guidance of a trusted financial advisor is the best way to determine the approach that works best for your specific goals. The bottom line? Dollar cost averaging and lump sum investing are both ways to invest cash. History shows that getting invested sooner is the most important way to achieve long-term financial goals. Thank you for listening. For additional information, please visit mraadvisory.com.